And joining me right now in a Fox Business exclusive is the Federal Reserve Bank of Dallas president and CEO, former Goldman Sachs vice chairman, Robert Kaplan. Good to see you, Robert. Thanks very much for being here this morning.
Good to talk to you, Maria.
And I know you were with the chairman, Jay Powell, on Wednesday. He was in Dallas with you, and he's talking about debt and this unsustainability that the U.S. fiscal path is in. How worried are you about debt?
Well, my concern at the government level is increasing debt to GDP is a tailwind right now. We've got a big spending agreement that was made last year. We have a tax reform, tax legislation. All that's providing stimulus. The problem is, in the medium and longer term, that tailwind could turn into a headwind because we're likely going to have to moderate our debt growth. So it's not going to be necessarily a problem this year or next year, but in the next several years, if we need to moderate our debt growth, which we think we probably will, it could turn into a headwind into the future. And it's not something we want to leave to our children and grandchildren.
Yeah, and especially as we watch interest rates move higher, it's costing us more to hold that debt. It's going to be $1 billion a day that we're paying on just the interest of holding that debt. It seems to me that debt and the disruption that it could cause is really a function of confidence. If markets and investors have confidence that we'll be able to handle it, it will be okay. But if they don't, and for some reason there's a trigger that starts getting markets worried about debt, that could be a disruption, cause a disruption in markets, and then it basically cycles down, creating a much bigger problem.
Listen, the world's reserve currency is the dollar. So in times of stress, and this is true today, people in times of stress look for safe assets. They look at the 10-year Treasury and they look at the U.S. dollar. And I think that's going to still be the case for some extended period of time, but it's not something we should take for granted or we should rely on completely. If the world doesn't need to stop buying U.S. debt. It just needs to lower their allocation a bit, and we're going to pay more for our debt. And so we should be moderating our debt growth.
And that is one worry for these markets. We're looking at a market right now, by the way, down about 200 points on the Dow Jones Industrial Average. Robert, I want to ask you about growth because you really were the first person, in my view, to raise your hand about a slowdown on the horizon. You joined me back in April of this year. And here's what you said about growth in the coming years. Listen to this.
In the near term, at the Dallas Fed, we're estimating U.S. growth about 2.5%, 2.75% in 2018. Unfortunately, we think growth will moderate next year, and we think by 2020 we'll be down to 1.75% to 2%. Now,
by 2020?
By 2020.
1.75% growth sounds so different than the 4.2% growth number that we saw in the second quarter of this year. Do you still stand by that, Robert? And will you walk us through, if so, how we get there? Sure. What's the catalyst?
Yeah. So, by the way, that was April. And as I sit here today, I think growth in the United States this year is going to be closer to 3%. So I was on the low side for 2018.
Okay.
We think it's going to be a little higher than what I said in April. The issue is, which was what I said in April, and I'll still say today, what I'm conscious of is part of the bump this year we think is due to this fiscal stimulus, the government spending that we talked about. Not the corporate tax reform so much as the individual tax cut financed by increasing debt to GDP. That's going to start to wane into 19 and 20. So underneath that, then we've got a slowing workforce growth, mainly because of demographics, because of aging. The good news is we're pulling more people into the workforce by having a strong economy, and I'm hopeful that will continue, but there are limits to that. So the big imponderable is productivity growth. If we can get a surprise and a bump up in productivity growth next year, then we can grow faster than what I said in talking to you before. The problem is, I think it's difficult to rely on that. I think productivity is improving for 70% of the workforce, and certainly for companies. The issue in this country, I believe, is, you've heard me say before, if you've got a high school education or less, you're probably not seeing those benefits, and your job's probably getting restructured or eliminated. So the issue is, back to where we started, unless we get a productivity surprise, which I'm hoping for. This is one forecast I'd like to be wrong about. Unless we get a productivity surprise, I think growth next year and in 2020 will be somewhat slower than what we're seeing now.
So, I mean, is that going to hit earnings? Is that going to hit just GDP? What gets impacted by a 1.75% GDP in 2020 or at the end of 19?
All right, and I'll bring this to what I'm seeing now that gets my attention. Global growth's decelerating. When I talked to you in April earlier this year, global growth was surprising to the upside. I think going into 19, it's probably going to surprise a little bit on the downside. The risks globally are to the downside, and there's a bunch of reasons: what's going on in Italy, what's going on in Europe, emerging markets, stresses, et cetera. The other thing I'm noticing, and I'm a business person, I come from the business world, I look at corporate earnings, and I talked about 30 CEOs a month. What I'm seeing is profit growth and estimates of profit growth are slowing. That's to be expected. We had a big boost from tax relief last year, but even with that, I'm seeing input costs are going up. The tariffs and uncertainty about the tariffs are having an effect. And so some companies can pass on price increases, some can't. In a little bit slower economy, you may see profit margins get squeezed. And I think that's what you're seeing a little bit in the markets. You're seeing some expectations maybe that profit growth is going to get squeezed a bit.